here, requesting you all to welcome the next panel on the dais. Now we're going to talk about the Investors Roundtable. This is the last panel discussion for the day and an absolutely important one. In this discussion, we will decode the investor mindset and get to know more about the investor perspective. Is the Investors Roundtable. You know, we're going to talk about money and much more. So over to you.
Hey, thanks everyone, and good evening everyone. It's a great pleasure for you to be here and giving us a chance to be talking about investors panel. Before we start in the panel, I would request each panelist to give a 60-second intro about yourself so that people know where you're representing. Before that, I'll start about myself. My name is Jinesh and I run a fund called Omnivore, which is a food and agri-sector focused fund. We invest into early stage companies. I've been doing this over the last decade.
Hi, my name is Anoop. I'm principal in the investment team at Chiratae Ventures. I lead consumer tech for the fund. And Chiratae, as you know, is an early stage sector agnostic fund from India for the last 16 years in the country.
Hi, good evening. I am Amit, Singal, founding partner of Fluid Venture. Fluid Venture invests in direct-to-consumer focused. Fluid Venture is direct-to-consumer focused fund, and we invest at early stage in D2C brands.
Hi, I'm Abhishek. I run RPSG Capital Ventures. We are an early stage consumer focused VC fund, typically coming into pre-series A and series A rounds of consumer centric businesses.
Hi everyone, this is Sanil, Sachar from Huddle. We're an early stage fund investing in, we're sector agnostic. We've been investing from pre-seed and seed ventures. D2C is a very large part of our portfolio, and looking forward to being roasted and grilled by you, Jinesh, for this session.
Yeah, thanks everyone, right? We'll go straight into the session details, right? All of you are professional investors, and a lot of entrepreneurs reach out to you for getting investments. What are the top 3 or 4 factors which you think are critical from your perspective when you decide to invest in a company or not decide to invest in a company? Maybe we'll start, Sanil, from you. You are one of the earliest investors, and we'll end with Chiratae, who's the biggest investor.
So the biggest criteria when we're investing, first is the founder's obsession to that problem that they're trying to cater to. That why are they doing it? You know, why are they trying to build a coffee chain? Why are they trying to build something in oral care? What is their depth of understanding and obsession in that specific solution? That's one of the key reasons. The second reason is if they've done any sales, how well do they understand that consumer? Like, you know, and I always evaluate this in trying to figure out what else is your consumer spending on? Who else are they interacting with? Why would they be referring you, or who is referring your product to them? So that's the second reason. I'll limit it because on why we don't, with one. If I get an inclination that they're just doing this because they feel it's going to be an easy outcome. And how I gauge that is, you know, when you realize what is their product evolution going to be? Have they thought through that? Are their answers literal or factual? Literal is researching the global landscape, and factual is, again, that data of the consumer. Then we are not the right people, because we don't think that gut does everything. Data and gut has to go hand in hand.
Thanks, Sanil. You want to take Abhishek on this?
Yeah, sure. I will not repeat what Sanil has mentioned because that is the basic which we see, and definitely those are the important criteria. But the difficult part for the startup founder is that I am a chartered accountant. So I believe numbers the most. So for me, it is very important that how the growth looks like, what is the customer acquisition cost, what is the repeat rate. And most of the time I have seen that founders come to me, and when I start asking these questions, they say कि मैं अपने CA से पूछ के आता हूँ. That is the most difficult situation for both of us. So as a founder, it is means whenever I am evaluating the founder, it is very important for me that being a D2C startup founder, you should have the number in hand. And definitely all those things are important, that what is the market size, how you are selling, to whom you are selling, what are the other credentials.
And at RPSG, what do you do, Abhishek? I mean, how do you guys look into that? And I also want to understand what you don't like from a company. That is also equally important.
Okay, so let me first actually give you a few things. Why do we invest in a particular company? If you're investing in a consumer brand, right? First and foremost for us, there has to be customer love for that brand, right? Just by buying revenues, whether that revenue comes at a profit or a loss, doesn't make any difference, right? Do customers know what your value proposition is, and does that kind of tie in with what the founder is essentially trying to kind of market to the customer? So measuring customer love, and you can do it through multiple manners, and eventually we've seen that this becomes a North Star metric, whenever you're kind of building a retention channel, retention cohorts, whenever you're kind of thinking about managing your marketing spend. I think that's the number one thing. Number two for us, which is also a subset of this, is what's your quality of revenues? Like the way Sanil mentioned, look, just buying revenues and earning like minus 40% CM2 doesn't make any sense, right? If there is a customer need that you're catering to, and you are kind of offering a solution that kind of satisfy that customer need, you will not need to spend insane amount of money. But in both these cases, if you feel that there's a gap, that's something that we kind of see.
Thanks. I mean, Chirag, you have seen everything, right? I mean, you've been doing this longest among all of us. So what's your take? And main focus on why you don't like something, because it's important for everyone else to know that what mistake they should avoid.
Yeah, I think when we started investing into consumer, this was back in the days when, say, the Mintras and Lenscarts and First Cries were some of the first investments we did from the Fund 1, and they're today iconic brands in the country as well. I think at that stage, it was very clearly to say that we don't want to do something which was a copycat playbook, right? So don't come to us and say you're building Uber for X, Airbnb for Y. Your reason to exist also is not because your competitor, which is say 2-3 years before you, raise some capital and has got say a 5 crore MRR, right? Your reason to exist or your reason to talk to an investor needs to be what is your specific insight that you bring into that conversation, which probably even I didn't know, right, as an investor. And I'm sort of looking for those new insights coming out from founders who have lived, breathed, sleep. That problem needs to be that well articulated, that insight stands out for us in that conversation. I think those are the two main things. And obviously, apart from that, I think we understand that we are in the brand space, and hence brand itself is the moat. As a technology investor, I would love to know from you at least how you plan to leverage technology, right? Because finally to scale, at least in the early stages, where you're not necessarily going to go offline and you're not going to play the omni-channel game right up off the bat. What is your idea of building out a product roadmap or a technology roadmap is something that I'm very keen to understand. Because I truly believe that that's what has made Lenscart today or a First Cry today a very, very profitable brand and standing out amongst the crowd, of people who sort of broken in that vintage, right?
Thanks for this. I mean, using the same thing what you mentioned, right? People using omni-channel. I mean, Sanil, you come very early in the days of a startup, right? I mean, what kind of channels would you prefer? Is it digital first approach or an offline first approach? What's your take? And depends on I mean, it would love to get your take way on that. I mean,
I think before I comment on whether it's digital first or if we're going to go offline, we have to segment the sector of the category that brand's in or the product category is in. So just for conversation's sake, if we are talking about one of our men's wellness companies called Bold Care, we know that they can scale online because digital first is important for them with a certain split of captive, which is their own website, and then marketplaces so that they can create awareness. But captive is very important for this category with a correlation to say that how much of a certain geography have you captured and now can you penetrate with that data in mind offline. Because one thing that I've observed and I've seen, and something we were talking about offline as well, in the offline channel, it's very easy to believe you're doing well if your products are out there. But your realization of how well it's doing actually comes, significantly later, and then, sometimes it's a little too late. Then there are other product categories in home care or, anything that is being used in a bathroom or a kitchen. You have to also have that presence offline because and leverage it across general trade and modern trade. And the biggest suggestion, because of the question you asked, I'll sort of conclude and pass it over. In the early days, we always believe quick A/B testing has to happen. Know what you're not good at also. And stay clear to your core data and try and replicate that core data when you're going offline.
Abhishek, your take, and then I'll throw some googly to Anoop and Amit.
No, I think a lot of similar thoughts, but in general, look, category by category, we have a strong opinion that, look, eventually every business has to go omni-channel, right? The question is, at which point of time do you start kind of amplifying or start expanding your, distribution reach or, channel reach, right? In let's say some of the categories, we are quite, in fact, one of the investments that Sanil and me actually shared together, at quite an early stage, the brand actually decided to go offline because of the inherent nature of that category, right? But the strategy over there is that, look, you need to be online, you need to expand your awareness online, you need to make the customer aware of certain novel products, novel categories online. That says, you've always seen that online gives you a greater bang, for your bank, right? And this is the reason, I think, look, very open to offline in general, but again, the question is at what point of time do you start expanding offline?
Cool, thanks. I'm slightly going to tweak the question, right? In a early stage deals, we will always have some failures. So how do you tell your entrepreneurs that let's experiment first, because no matter how much analysis you do, you don't get the answer till you go in the market. How do you tell your founders, guys, let's experiment first. If it has to fail, let's fail fast. Then up to you.
Yeah, sure. So startup is somewhere where the success is extremely difficult and failure are obvious. So we closely work with our founders to make sure that whenever they are experimenting, it should not be like that they are very emotionally attached to any particular the way they are doing that experiment. So we always suggest them that in case that way of selling is not working, you should find out the alternate way. In D2C, largely it is the product market fit, which founder will have to find out. And in case customer is not liking the product, they should immediately start finding the reason that why they are not liking it, and they should do the tweak, whether price point is incorrect or whether the product is something which customer is not required. So we always suggest that keep experimenting, but do not relying on that for so long. And that's how we make sure that the money is not being burned only in the experiment, but keep changing the product and other thing as well.
So I think the first approach is obviously that the founder comes in with his approach to going to market, right? With whatever he has in his strategy. You try and set certain metrics to ensure that while he's doing his own approach, but he knows what the borderline boundary conditions are to sort of measure success or measure failure. And as soon as those are breached, I think it is it's sort of on the board and the investors to sort of make him set aside at least a certain part of his budgets, OPEX, to on experiments and make him experiment on 2 or 3 specific outputs. Give him a quarter or so to sort of experiment, him or her, a quarter or so to experiment on those new approaches, and then see which sticks. I think the going in proposition is to go and advise the founder to sort of change course and go for experiments. I think that will just kill the entrepreneur's own motivation to building his own startup, right? So to that extent, you go with the flow, make sure that you try and make that process a success, and if not, quickly ensure that they are experimenting to identify what the next pivot could be.
Cool, thanks. Guys, I mean, the audience, if there are any specific questions you have it, we want the panel to take a stab at it. Please feel free to ask questions. Yeah. I mean, there's a mic. Come here, I'll give my mic.
I think in this crowd of D2C, I'm the only B2B one here. I'm here for you guys particularly. So my company, Relator.io, which is a B2B company in the prop tech segment, they recently got backed by HDFC. And now, right after that, we hear a merger of HDFC Capital, HDFC Bank, and HDFC in general. Now, to understand the investor domain, I have a very particular set of questions, which is, as an investor, would you prepare the company go ahead for the next round of funding? And on what basis you decide the percentage on pre-money valuation? How do you decide after what period they should go for the next round of funding? And what are your liquidation preferences?
I think I feel like my investor is asking question to me, right? Yeah. But I will let Anoop and Abhishek give a shot at this. I mean,
Abhishek, first you.
So the three.
So you're all trying to avoid this question.
Yeah. Okay, so the 3 questions that you essentially asked, right? So one is the liquidation preference. The second is how do you value? And sorry, just remind me what was the third question? The first.
So how do you decide the percentage on pre-money valuation? How do you decide after what period they should go for the next round of funding?
Okay.
And what are your liquidation preference?
Okay, I'm going to give you a framework rather than giving you a direct answer, because I don't think so there's one answer that kind of fits all situations, right? Let's say whenever you're coming in at an early stage, or any investor who's coming in, whether at a seed stage or a Series A stage, right? You are funding with a certain business plan or a certain idea in mind or a certain milestone in mind, right? That the company needs to achieve this. It could be a certain revenue number, it could be a certain profit number, it could be a certain operating metric, something, right? And essentially you feel that, look, your money should be able to get you to that level or get the company to that particular level, right? And of course, with every money, initial period is about experimentation, right? And once you find that, okay, fine, XYZ experiment is actually working for you, you start pumping money into that, and eventually the growth comes, right? Now, when that growth cycle is essentially happening, right, and you know that, look, your target is inside that maybe in 6 months time or in 9 months time, you're going to eventually achieve it. I think that's the time when you should start your fundraise, right? And eventually, look, like any deal, it does take, anywhere between 6 to 9 months to kind of close, right? So hopefully, you can kind of time it, accordingly, plus minus, whatever. At least that's how I look at, from a timing perspective, right? And other than that, look, even if the experimentation doesn't do well, or let's say if the company is not doing well, I always feel and I always advise my founders to ensure that there is at least 18 months of runway left with you, right? And at a time when you feel that the runway is kind of, reducing, it's time for some changes into the business, right? But even after those changes, let's say, for example, you're down to a period where, you only have about 6 to 7 months of runway left. I think that's the time to, probably hit the markets or, kind of amplify your discussions at that point of time. So that was your first two. From a valuation perspective, look, very, very difficult. I really wish someone would also teach me, if there's an exact science on how to value the company. I think it's a function of a lot of things, right? It's a function of, first and foremost, I think your conviction on the company and the founder, right? It's your call in terms of, how fast do you foresee that space or that product to eventually kind of grow. And then eventually your expectation, for risk and return as a benchmark. So let's say, for example, there are investments that I have done where I felt that, look, this is a really risky bet and I need to make a much higher return. But like everyone's portfolio, I've also had bets where I know that my risk in a particular investment is very low, right? In which case I'm okay taking probably a moderate sort of a return, right? And once I kind of model that out, I kind of work backwards. And then of course, you have all your other, sciences in terms of, your multiples, your trading multiples, your transaction multiples, etc. that you, typically kind of follow. So I think accumulation of all of this eventually, kind of gets you to a certain valuation. In terms of dilution, usually what I've seen a market practice, if I were to even give you a number, if it's a proper round and it's not a bridge round, usually there's a dilution of between about 10 to 20%.
Thank you so much.
I think, Anoop, you want to add something?
No, I was just about to say that valuation is both, it's exactly like what Abhishek said, it's both mathematically arrived at and it's also something which you have certain objectives, right? He talked about in terms of a dilution, as an investor I will say what kind of a stake do I need to participate in a particular round and make it meaningful for me to be present and be part of your journey for say 7 to 8 years of an average holding period, right? So that could be anywhere in the range of around 10 to 20% in that sense, and hence that's the investor hat to saying at early stage or a seed stage or pre-seed stage that what would be the right entry valuation at which or entry stake at which we would love to participate in a round, and hence valuation can also be backward derived, right? And then validated broadly to say that whether it's roughly in the ranges that a revenue multiple or a product growth potential is sort of offering as supporting metrics to that valuation number as such. So that's the only additional input on that question.
I hope you got your clarity of answer, right? Because investors have not got any clarity how we value our companies. Using the question what she meant, like one thing is also you have to realize that while we make investments, we always want to get the companies to be a home run, right? A home shot. But it's not always the case, right? So we will see more companies dying out than not. That's a hard reality of entrepreneurship, right? So maybe I want to take to the next question, and Sanil, I want to go with you. You come at a very early stage. I went to a retail, we spoke to a few retailers, right? I'm not a consumer investor, but what I realized is that on average, 100 new brands are being launched in India in the trade right now. And you speak with most of the guys, they say at the end of third year, maybe 5 brands of the 100 have survived. So 95 will die. So want to understand what are you seeing this happening, and what are you guys thinking about how to reduce that number of mortalities?
I'm glad we're coming to the end of the session when you're throwing these questions. But I think the only area that I would ask someone to focus, a brand to focus on right now, is retention. It doesn't matter figuratively if you have 10 customers in the first year and even 10 in the second. The question that I would like to be a part of that journey is that how many, is your retention above 35%? Is it above 40%? That's a huge number in what I've just said, but retention is the most important bit, because retention ensures that you've got a core customer set who you can build for. Now, the consumption pattern right now, when we look at it, right, we look at the economy, and then you have to also be very mindful as a consumer founder or a consumer, and I've been on both sides, as an investor and a founder, you'd be very mindful that what is that consumption pattern of the retained audience now? And can I even build, is it the right time to further try and upsell them something? The reason I'm just sticking on retention is because surviving when you're only focusing on a top line is like ensuring that the entire cloud, reigns for the entire city. You can't do that. Top line is a cloud, as is valuation in a venture we don't see returns in. So I think for me, it's just retention as a focus.
I mean, Anoop, your take, then I'll go to Abhishek and then Amit.
So this is on, on the question of... Yeah, so as an investor, we have attuned to that, right? Like I think we offer risk capital. Risk capital comes with a downside. As a venture fund, I think if you are not willing to write down or write off 20 to 25% of your investment corpus, I don't think you're taking adequate risks to your investors to get alpha back. But that doesn't mean that we wish for our investments to die or so. But we are specifically contextualizing it to this audience of D2C. I think overall, when you look at survival rates, I think D2C, at least from a brand, and I think that's what Sanil was also trying to say. As long as you hit your core audience and core value proposition right, you can make it a longer longevity business, which may not necessarily yield valuation upticks, but definitely it can become a sort of a cash flow business as such, right? Which may not be a venture outcome as overall, but definitely a slow paced growth. So to that extent, I think in D2C environments, I don't think death rates are the biggest concern, because you may find in technology the death rates being far more higher than necessarily in consumer as such. At least that's been the experience from our side.
Thanks. Abhishek, your take?
See, the way at least I look at a brand, right, or consumer as a space, I think it's one of those unique categories which actually lends itself to almost like a 60-70% gross margin from day one. Very, very few categories, come up with something like this, right? Secondly, look, brands are not built in 2 years or 3 years. Unlike, let's say, many of the tech businesses, network effects in brands actually come after a certain scale, right? As consumer founders, I always feel, and I always at least advise them that, look, building a brand takes time. Be patient about it, right? Stay true to your core. At least let the brand stand for something and let the customer kind of understand that, why he or she is kind of purchasing a certain product. Okay. If you kind of do that and your unit economics you kind of hold along that time and you just don't chase revenue growth, usually I have seen mortality rate in companies being, at least in consumer companies, being very, very low. The inverse of that happens once you kind of deviate from these core principles.
Thanks, Amit. Your final take, and then I'll close and make a closing statement.
Yeah, so I will echo what Sanil mentioned, that stickiness is extremely important for consumer brand, and most of the brand which come to us, we find it Me Too brand, like someone else is doing, we are also doing. So the probability of dying is extremely high in those cases. In case there is certain moat and you are clear that what is the brand proposition for the customer and you are communicating it very well, that will be very good in D2C. So brand communication is an extremely important part, and product, as always we said, that product is the key.
Thanks, everyone. This brings us end to the panel discussions. If there are any follow-up questions, do you have a time to take any questions? I think I've been said no, otherwise you can't blame me. Thank you, everyone. Thank you, the panelists, for participating in the panel, and thank you, audience, for giving us a patient history listening. Thank you.
Nice. Thank you so much, gentlemen. I'll request you to take a picture together, and if you have any questions, don't shoot the messenger. You can take the questions offline as well. I'm sure these gentlemen will accommodate the questions that you have. Also, they are not just the panelists. You also are seeing a jury of the awards that are happening in the evening. I'll request you all to kindly stay back for felicitating some of the winners in the beginning. Let's get a picture together with the fantastic panel right here. And I'll request all of you to kindly put your hands together and show our gratitude to the wonderful gentlemen on the dais. Gentlemen, just one more minute. I'll request you to stay back on the stage as I invite Mr. Himanshu Nagrecha, Vice President, South Asia, Traffic Guard, to show our gratitude through these amazing goodies that are coming on the stage. Thank you so much, gentlemen. And with that, we conclude the summit of E4M D2C Revolution here, but we are not done.